In global foreign exchange markets, currencies are always priced in terms of other currencies. The resulting price difference between two currencies is called the exchange rate. The term cross rate is also used to describe one currency in relation to another. While every exchange rate is a cross rate is often used to describe transactions that do not include the US dollar. The 8 most popular CME Group FX contracts are all against the US dollar, but there are a variety of actively traded cross-rate futures for market participants with non-USD currency risk. Consider an exporter who is expecting to receive 1.5 million euros in December that he'll want to convert to Japanese yen. Since it is currently September, he has exposure to the FX rate between the euro and the Japanese yen for 3 months. He can manage this exposure using December euro-yen futures contracts. Since buying one contract is equivalent to buying euros in exchange for Japanese yen, and selling one contract is equivalent to selling euros in exchange for Japanese yen, he decides to sell euro-yen futures contracts to implement the hedge. For this example, assume the current futures price is 147.25 Japanese yen per euro. To determine how many contracts he needs to sell, he takes the amount in euros he expects to receive, 1.5 million, and divides it by the euro-yen futures contract size of 125,000 to get 12 futures contracts. He'll buy 12 futures contracts to enter the position and will sell them in December to close the position. Say the Japanese yen appreciates, resulting in the December futures price moving from 147.25 per euro down to 145.75 per euro. In the cash market, 1.5 million euros has a value of 218,625,000 Japanese yen, which is less than expected had the exchange rate not changed. The lower outcome in the cash market will be offset by the gain from the futures position. On the other hand, say the Japanese yen depreciates, resulting in the December futures price moving from 147.25 up to 149.75 per euro. In the cash market, 1.5 million euros has a value of 224,625,000 Japanese yen, which is higher than expected had the exchange rate not changed. The higher outcome will be offset by the loss from the futures position. Either way, the futures hedge serves its purpose in keeping the exporter close to the overall expected return from the transaction. Cross-rate futures are margined daily, and margins are collected in the quote currency. For example, since the first currency in a currency pair is the base currency and the second is the quote currency, margins would be collected in Japanese yen for euro-yen futures contracts. Cross-rate futures are physically delivered on settlement day, which occurs on the third Wednesday of the contract month. More information about FX futures, including cross-currency futures, can be found at cmegroup.com/fx.